Is the U.S. skidding toward recession? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Darius Dale, founder of 42 Macro. Hi, Darius. Great to see you.
Hey, Maggie, it's a pleasure to be back with you. How are you?
I'm doing well, thanks. I'm doing well. We are looking at kind of mixed action in the market today. We had the Dow up, NASDAQ lower, equities just closed here as we're speaking. Treasury yields fell a little bit, but it seems like the focus has really been on some of this economic data that's been coming in. Much of it this week weaker than expected, including those private payrolls, ADB private payrolls we had today, and ISM services index. What is your dashboard suggesting? Is the U.S. economy headed toward recession? What do you see happening?
Yeah, I mean, look, it's we've been saying this for a while now, but the U.S. economy is very, very resilient for a variety of different factors, which we can unpack. And as a function of the resilience, the Fed is going to tighten more than the markets are anticipating. Both of those things have been realized, both in the data and in market and in Fed reaction function terms. And as a function of C is we're going to wind up in an economic downturn. I happen to believe the economic downturn we're likely to experience is something that's likely to commence. Our models would suggest that it's likely to commence sometime in Q4 of 2023 or at the very latest Q1 of 2024. That may be in the process of being pulled forward. I'm not sure we have enough data to confirm that or not. But ultimately, I think the number one thing that I think market participants are missing is they're debating soft landing versus mild recession, where we're debating mild recession versus severe recession. And I think that's a debate that the market is eventually going to be forced to have, I think, sometime in the second half of this year.
Yeah, and you kind of see that playing out now because when the weak data first started coming in, everybody was, or certainly equities, I shouldn't certainly shouldn't say everyone, but equities were like, oh, this means the Fed's going to pivot. And then all of a sudden now they're trying to fill in like, well, what does that mean if the data is coming in weak, or if the market is pricing in eventual Fed easing, which we can talk about whether you agree with that. What happens in the interim to get us there? I mean, that's the thing the market seems to have glossed right over.
Yeah, I've been saying that for a while now, but we're not going to get the drugs without going through the soup first. And then the soup is the economic downturn and ultimately the market pricing in of that economic downturn that gets the Fed's attention to supply the market with the liquidity that it needs to, have extended bull markets. We've been in this sort of what we call phase one liquidity cycle downturn since going back to the fall of 2021. And we've been on this program talking about, helping investors, protect their hard-earned capital through, from that part of the process. We are now in the part of the process where markets are appropriately trying to discount whether or not this is going to be a soft landing or if we're ultimately going to wind up in what we call the phase two credit cycle downturn, which is the result of all that liquidity reduction that we're seeing. And on that liquidity reduction, we are now starting to see, some pretty significant moves lower and things like, M1 bank deposits in small regional banks. Brian, if you throw up chart 100 from our March macro scouting report, we just contextualize, the move in liquid deposits from some of these small regional banks. And I don't even want to say the word small. That's what the Fed calls them. The 4,000, let's call it 675 banks that are not, in the top 25 in the U.S. banking sector are technically small, according to the Fed and their H8 indicated release. And this chart shows we're currently drawing down liquid deposit these institutions at a rate that we've never seen before in like the 60-something, 70-something year history of the time series. So that's very concerning. Also very concerning is the fact that M1 is contracting at its fastest pace ever at down 5.8% year over year. Bad things happen when liquidity in the private sector starts to evaporate and deflate the way it does, and you don't have a commensurate amount of money reflation out of the public sector. And in order to get that money reflation out of the public sector, I'll tell you two things that can't happen. If you throw up slide 29, Brian, where we show the inflation indicators in our macro scouting report, whether it be median CPI compounding at 7.5% on a 3-month annualized basis, trim mean CPI compounding at 6.2% on a 3-month annualized basis, whether it be median PCE at 5.2, trim mean PCE at 4.7, and the Fed's core or their preferred inflation gauge at 4.8%. All these numbers are compounding at levels that completely remove the Fed from the liquidity supplying business for an extended period of time, in our opinion. And so ultimately, we think the Fed knows that, and which is why, if you look at slide 46, Brian, they're forecasting a mild recession. If you look at their forecast, if you look at the most recent summary of economic projections, which we got a couple of weeks ago, their target for the year for the unemployment rate for year end 2023 is 4.5%. That current unemployment rate, we're going to get the number in a couple of days, but the most recent one for the month of February is 3.6%. So if you look at that implied 90 basis point delta, there's never been a 90 basis point delta to the upside in the unemployment rate in the history of the time series going back to the late 1940s that didn't coincide with the red bar in that chart, which is a recession. And so it's our belief that because inflation's too sticky, because the Fed is implicitly forecasting a mild recession, their response in liquidity provision terms, i.e. that unencumbered QE and those rate cuts that we ultimately really want as investors, it's going to take a while in our opinion. And that taking a while is going to be a problem for asset markets in the second half of the year, in our opinion.
Yeah. So what happens? Where are we with inflation? We're getting some indicators out next week, some important gauges on that. Would you expect to see that fall in line with the fact that we are seeing economic growth fall and maybe the labor market weaken? Should we expect to see prices fall as well?
Yeah, so inflation is likely to continue deteriorating and decelerating, but it's just not decelerating fast enough. I mean, that's the problem with analyzing so this is the problem with most investors looking at inflation on a year-over-year rate of change basis. They're being sort of tricked, if you will, I don't know, for lack of a better word, by the change in the base effects, and then I realize that inflation, and on a sequential basis, is still compounding at levels that are very wildly inconsistent with the Fed's price stability mandate. And so, at best, we're talking about a Federal Reserve that is set up to pause, even as inflation continues to decelerate. And I happen to think it will continue to decelerate. If you just look at the data point we got today in the ISM services release, we saw the prices component slow 6.1 points to 59.5. That 59.5 is the lowest number we've seen since July of 2020, and that minus 6.1 delta is the sharpest deceleration we've seen since May of 2017. So inflation is decelerating. It's just decelerating to levels that are extremely inconsistent with the Fed's 2% mandate, price stability mandate. And until we get some indication that inflation is going to sustainably get to 2% and remain there, and I don't understand how you can get to that indication if we're not even compounding at 2%, let alone with the fully employed American economy. I just think it's going to take a while for us to get that liquidity that investors are speculating on in the markets right now.
Yeah. Do you think that the Fed has any more rate hikes in store? Because, as I mentioned earlier, we kind of flipped right to, they're, especially in the wake of the banking crisis, they're going to be easing. They're going to be, cutting rates. Do you think they pause, they keep hiking? I mean, where or how do they deal with those two very different issues that they're addressing, both on the banking side and on this sticky inflation side?
Well, Powell more or less called it out, which is, they don't really know the full extent of the credit contraction we're likely to see as a function of this sort of, revision in the asset liability mix of these regional banks. Moreover, the changing regulatory environment that's likely to come by. We're still in a democratic regime. They still have full control over all the regulatory agencies in America. So we're probably going to see tighter regulation for some of these banks as well. So we were going to see the asset base and these institutions really start to decline. So that's an issue. The Fed knows that that's a pending issue, and so they're likely, as Powell communicated in the press conference, they're very likely to take it easy on rates. We may see one more rate hike. In fact, I do think if the jobs report comes in line as it's expected to, or sort of comes in line with where it's currently expected by Bloomberg consensus, for instance, I think we will see another rate hike, because I think ultimately what's happening, this is an economy where the Fed has barely gotten the policy rate restrictive enough to really do a lot of damage, and the risk that they pause too soon and allow asset markets to reprice growth and inflation expectations from a nominal GDP perspective higher will ultimately cement all those numbers that we highlighted in terms of the 4 to 5 to 7%, median and core underlying inflation type measures. We're going to be stuck there, is what I'm saying, if the Fed allows asset markets to take their pause pivot and run away with that to the upside, both in market pricing terms and inflation expectations terms. So I don't think they want to do that. I think they want to, act tough for as long as they possibly can. But ultimately, that pivot that's coming is going to be a pause. And the issue with pausing here, from our perspective, is that pausing is not going to be enough from the perspective of the long and variable lags of monetary policy. If we're right on recession commencing by Q4 of this year or Q1 of next year, pausing ain't gonna help.
Yeah.
You need to be cutting interest rates and doing QE. And that's the issue. And I think that's going to be a big issue for asset markets. They're going to have to use their price action to tell the Fed to deliver the drugs in my opinion, by the end of the third quarter.
Yeah, and this is, I mean, Cleveland Fed President Loretta Mester was sort of suggesting the same thing, that they need to go a little higher to deal with inflation. But as you just pointed out, they're really, and as many, we've been having these conversations for the last few weeks. Certainly you and I for a while, but is really picking up steam with the folks we have coming on saying, hey, hang on a second, the Fed's really stuck in a very bad spot here. Because if they do that, Darius, doesn't it just exacerbate some of what the strains we're seeing in the banking sector? If they don't,
Yes and
they
no. I
don't
mean,
ease, if they try to hike again, doesn't that just create more pain for in the banking sector?
yeah. So yes, the answer is yes. The way I would couch the answer, yes, is this is kind of what they wanted, right? The Fed didn't hike interest rates so that there would be zero strain in the banking sector, so that banks could remain extremely profitable and continue to extend credit. That's not why they hiked interest rates. They hiked interest rates to cause strain in the banking sector so that they could slow the credit machine and ultimately slow the real economy, and alleviate some of that pressure from a supply and demand perspective in the labor market. This is what they want. They don't want banks going bust, week after week, and have a full scale banking crisis. What they want is more, that's like I liken it to an airplane analogy. When you're flying and you're about to get to your destination, when you're 25 minutes out, captain comes on and says, all right, we're going to begin our initial descent. And you go from like 35,000 feet to 10,000 feet. And then you go from 10,000 feet to the ground in the second phase of the descent. The Fed wants that process. The Fed doesn't want the process where the captain comes on and drops the oxygen mask out and says, brace for impact at 35,000 feet. That's the bad part. Both outcomes land on the ground with lower inflation and higher unemployment. But one is a more desirable path than the other. And I think that's what the Fed is trying to accomplish.
Yeah. And you didn't mention all that turbulence and chop as you make your way down, too. I thought that's where you were going with that analogy. And that would be accurate as well, because it's not, as anyone knows, once you start to make that descent, it's not smooth flying. It's often, where you hit all the turbulence. We do have some questions coming in. We're going to get to them in a second. But for those, so it's interesting that we're having this conversation. For those, I had a chance to sit down with Harris Kupperman today, and we talked about some similar things. He's taking a really deep look at oil, the energy sector, especially in light of OPEC's production cut. But he was also concerned about this issue of sticky inflation, what it means for the Fed. And he's actually worried that we could see both a banking crisis and an energy crisis at the same time. Let's have a listen to that clip. You don't hear a lot of people talking about an energy crisis. You hear them talking about a banking crisis. You hear them talking about a hard landing. You hear them talking about, a knock-on demand destruction off the back of that. So it sounds like if the markets doesn't have their head wrapped around this, where's the pain trade? What suffers as a result of this?
Well, I think consumers going to suffer. I mean, we can have a banking crisis and an energy crisis simultaneously. There's nothing that says you can't. I mean, in the 1970s, we did both. I kind of think we're going to do both. I think the pain trade is anything tied to interest rates. I think that, at some point in the not so distant future, Powell is going to have to make a choice between saving the banks and, chasing oil across the screen. And I think he's going to decide to save the banks just because that's probably the more politically expedient thing to do. And he's going to let inflation run really hot. And I think the net result of that is the 10-year probably falls apart, and then all the banks fail. Because, if the 10-year goes to some high single-digit number, I mean, I don't think you have any banking sector. It's not just the little, kind of fragile ones. I think you're going to have like a banking crisis with an energy crisis. I think it's going to look a lot like the 70s.
Yeah, and that was only a little small part of that. Cuppy had a lot of strong, out of consensus views, including some very blunt warnings about bonds, but it was a fantastic conversation. I encourage all of you to watch the whole interview. And he does talk about how he's positioning and trading around this setup. If you're not already a member, scan the QR code, come and join our community. This is the exact time we need to be having these kinds of conversations. But Darius, it is out of consensus. Certainly not everyone agrees with what Cuppy's saying. The one thing I will say, though, is he's a little bit, this is his longer term thesis. So I think it's kind of important to put that out there. But do you see this as a possibility? Could we have a banking crisis and an energy crisis, like an oil spike at the same time?
I think it's all one and the same thing. And yes, I very much agree with them longer term. I don't know that I would use the word crisis because I think what's more likely to happen is just persistent capital outflows from the US economy, which, by the way, we doubled our net international investment position in the 4 years to 2021. A lot of that capital has to go to find homes elsewhere as the, for lack of a better word, US bond market seems, permanently impaired. I mean, we're obviously going to get a rally in bonds in the context of a business cycle downturn, but I don't think we're going anywhere near where we were prior to this, COVID, prior to this, most recent business cycle. So, in our opinion, bond yields are likely to make higher highs and higher lows over the long term, and that's likely to be supported by persistent capital outflows, weaker dollar, and ultimately a weaker dollar should continue to reflate energy prices. And oh, by the way, this is all very consistent with the fourth turning. And so you think about where we could be at this, in this moment in the next business cycle, i.e., very late cycle, very high inflation, Fed fighting inflation. We're all going to be doing that process from higher, from a higher low, higher highs in bond yields, lower U.S. dollar values, higher energy values, and ultimately we're talking about, a situation which could be bumping up against what could be ultimately like the pinnacle of this fourth turning that we've all been living in from a geopolitical tension standpoint, from a domestic tension standpoint. There's a lot of stuff coming at us over the next 5 to 7 years that I think, ultimately will feel like an energy crisis and a banking crisis simultaneously, because there's a lot of capital that's been dammed with like water dam into the U.S. economy that is probably likely to find a home elsewhere. So I tend to agree with them, maybe just not in terms of the acuity of the whole situation.
I think that's a really important comment, Darius. And I think this plugs together. A lot of times we hear people talk and they seem to have really, really opposing views. But I think you just explained it really nicely that this is part of a major shift. And so sometimes the timing's off. But when you hear people talking about, disinflation or deflationary impulse coming and buy bonds, and you have to ask them always what their time horizon is, because they may believe that short term, but if you go further out the time horizon, they may swing back to where Cuppy is, and Cuppy's, as a hedge fund manager, kind of looking for that next move. So they may be connected and have more in common than they would appear to have at the surface. So I love the way that you just explained that, and I love the idea of the dammed up capital of having to find a home elsewhere. I think that's going to be a really important shift and change, isn't it?
That's going to be a huge challenge for the U.S. government for a long time. And I'm not one of these people that says, okay, interest expense is here, therefore the government's bankrupt. That's nonsense. We're still the reserve currency. But I am one of these people that understands that the term premium, let's use a 10-year example, in the bond market is still deeply negative. It's somewhere around minus 60 basis points. That's not going to remain the case in the context of secular capital outflows from the U.S. economy, a persistently weaker U.S. dollar, and persistently high inflation. I spoke about our secular inflation model on this program and in quarters past, and that model is currently tracking at around 2.9% for the stationary mean of the core PCE time series, which doesn't sound like a lot, but that's almost double from where it trended at pre-COVID, and more importantly, it's above the Fed's 2% inflation target. So unless they change the goalpost, move the goalpost, which I happen to think they're probably going to when unemployment rate gets higher enough, but they won't be able to change the goalpost until then. Unless they change the goalposts, inflation is going to be persistently higher than their price stability mandate. Recall that we're exiting a regime where inflation was persistently lower than their price stability mandate, which gave them political air cover to consistently remove duration and treasury supply from the market, which made it very easy for capital markets to function, very easy for stocks and bonds and crypto and everything else to appreciate, made it very easy for us to buy Lambos and go on, mini vacations. It's going to be the exact opposite. We're going to have a Federal Reserve that's going to be persistently tighter relative to where we've been in years past. And that comes with a whole different set of asset allocation instructions and rules. And ultimately, it's just going to be a much more difficult environment to generate returns from being just naked long of beta and expecting the Fed to consistently supply the market with liquidity. And I think that's a multi-year process. I don't mean it to sound like that's something that you need to price in today or tomorrow, but I think this is the regime that we're in. And I think the sooner our viewers, realize that's the regime we're in, the better they will reorient their strategic investment objectives to account for that.
Right, which is why we keep hearing people say, and in fact, at one point, Cuppy said it's a great environment when he was talking about a dual crisis, and I said, well, that watch the interview, everyone, but I challenged him on that and said, what does this mean? Doesn't this? And he said it's a great time to be a macro investor, and this is what we all have to wrap our head around now. It's a much more complex landscape.
Maggie,
Go ahead.
100%. And you never want to be the smartest gal in the room in a trending market or in the same regime. Where it pays to be the smartest gal in the room is during regime change. Because that's where the money is made. If you understand the transition to different regimes sooner than the rest of the market, sooner than all the beta and the passive flows associated with the previous regime, that's how you can set yourself up to make some very positive strategic returns. But absent that, I mean, I think it's just going to be a very difficult environment for the next 5 to 7 years throughout the duration of this fourth turning until we finally get the big solutions that we need to the big problems that still lie ahead of us.
Right. And that's why, we have folks like you coming on trying to and help guide everyone. So let's hit some questions. I'm looking at them cold. So some of them we may have already gone over, but I'll either skip through them or we'll add some more color to it. Sohab asking, saying, hi, Darius, I'm a 42 macro subscriber. Love your work. I wanted to ask if my framework is correct. Recession, hard landing equals shortage of dollars equals dollar rally. Is that correct?
Yes. By the time you get into the depths of the recession, generally speaking, you're talking about a severe destruction of private sector money that does tighten, credit conditions, particularly in the money market. So you're likely to see dollar rally towards the middle back end of recession. The problem with trying to price the dollar rally in today is you still have China accelerating from an economic standpoint. You have Europe still accelerating from an economic standpoint. So there's a lot of risk capital flow that is heading in those directions. And that's what you're seeing from the perspective of the dollar. Eventually that will wear out, in our opinion, because again, I don't think China, we've done a tremendous amount of work on this. It's very clear China's not stimulating enough to sustain a positive growth impulse well into 2023. And ultimately, we still think Europe is on a lag to the US economy from the perspective of its business cycle by 1 to 2 quarters. And so ultimately, both of those positive impulses will fade, and the risk capital that's chasing those markets today will, at the bare minimum, stop. And if it just stops, then you're shifting capital back into the U.S. economy as investors start pulling back in the repo markets, et cetera, et cetera. So I think the private sector money deflation that we highlighted as in terms of the M1 contraction, the deposit outflows, et cetera, I think that's all going to be dollar positive in the second half of the year. Maybe not from the early part of the second half of the year, but I think by Q4 you're probably likely to see stronger dollar, if only on a transitory basis.
Yeah, and the follow-up part of that was, if so, could the moves in XAU reverse, or is the relationship likely to break down as we get a rally in both gold, silver, XAU, Philadelphia Gold and Silver Index?
I don't invest on the basis of 0 percentile or 100 percentile readings being made in the future. And what I mean by that is this time is different.
Yeah.
I invest on the basis of, assuming some mean or some state, and ultimately trying to be Bayesian enough to understand how far away from that mean or that steady state, that equilibrium we are. And so in my opinion, yes, when the dollar starts going up, you're probably going to have a decline in gold. You're going to have a decline in anything that's inversely correlated to dollars, which is pretty much most assets. Your house is inversely correlated to the dollar. Bitcoin is inversely correlated to the dollar. Ethereum, gold, stock market, everything is inversely correlated to the dollar because the dollar is the global reserve currency. It's what assets are priced in, generally speaking. So it's a multi-step process. I still think we're in this phase right now where we're debating soft landing and mild recession, and neither of those necessarily requires a severe phase 2 credit cycle downturn, which is yet to be priced in. I think by the time we get to mid to late Q3, it'll be very clear that we're debating mild recession or moderate recession. In our opinion, if we can, stay on this trend with respect to like the ISM services data point that we got this morning, for instance.
So this is a great question from Saul. In what sense does the bond market own the Fed? Several guests have stated that the Fed will have to cut due to the bond market pricing in the cuts. Why?
Yeah, so if you throw up slide 5 where we show our macro weather model, we have about 20 different indicators in this model tracking all the different 10 components of macro. And if you look at our interest rate component in the middle right section, we have 2-year yields tracking at minus 117 basis points below the benchmark policy rate. I mean, that's about as low as you're going to get, in terms of like what the market is willing to price in relative to what the Fed is clearly guiding to. We're seeing this across a variety of short-term interest rate curves, whether it be the near-term forward spread, the 3-month, 2-year. Pick your short-term interest rate spread. They're all basically challenging the Fed and playing a huge game of chicken with the Fed. The markets lead the Fed, by the way. Let's be very clear about this. The markets do lead the Fed. Now, the problem with it from the perspective of risk markets is I think risk markets have gotten away from understanding the process of how we get the drugs from the Fed. The bond market can price this in because it's a one-step process. Eventually, the bond market will be right, but it's not the same necessarily. The market's not going to be right because you have this thing called an actual economic downturn, an earnings recession, and ultimately policy, the money creation in the private sector side of the economy is going to be too great, or too deep. The deflation is going to be too great, and force investors to actually use those types of instruments to raise liquidity, to maintain their lifestyles or do whatever it is that they want. Right now, no one has to sell Bitcoin to go on their next vacation or feed their family. I think in 6 months, certainly by 9 months in our view, they will be selling Bitcoin to maintain their lifestyle, and eventually they won't be able to maintain their lifestyle. And so that's my issue. And that's not an issue for the bond market, but it certainly is an issue for risk assets.
I love it. Darius, one thing I've learned about Real Vision viewers, they have a fantastic sense of humor. They like good music, and they are ready to pull up for a happy hour anytime. Irish making a comment, wait, no more Lambos? Exclamation point, question mark, exclamation point. I love it. Okay, we have from G Blackburn. Darius, can the banking system handle a credit crisis? What happens if credit really rolls over?
Sorry, can you repeat that? My apologies.
Yeah, sorry. I think I froze. You froze. Our signal's like not great, but we're going to push through. G asking, can the banking system handle a credit crisis? What happens if credit really rolls over?
I mean, I don't know that the question is answerable. By definition, if we having a credit crisis, the banking system is not handling it, right. If they're handling it, there will be a credit crisis. So
maybe are we fully anticipating that that contraction of credit? Do you think the market or earnings are reflecting that? I mean, there are some talk that it could be. There are some people.
I work on this. This is not. Yeah. So my view on this, and we've done a bunch of work on this in our 42 macro. This is not the issue in this business cycle is not necessarily credit or credit quality, although I think in the commercial real estate, particularly office segment, we will have an issue in credit quality in the coming years, most likely starting next year. The cycle, we have a liability problem. So that in the previous credit crisis was an asset problem. Banks, their assets, were just wrong price. They had to mark them down, and ultimately that caused a lot of insolvency in the banking sector, and then ultimately, all the the unsecured lending that was happening in the interbank market really came home to roost, and that was a big issue. That's not really a risk at this point. The risk at this point is the liability side of bank balance sheets is going to draw down in a way that really should materially negatively impact the real economy and ultimately negatively impact earnings and jobs and things of that nature. So this is more of a traditional business cycle in which the Fed succeeded in destroying private sector money, which is what it wanted to do. It's the whole point of tightening monetary policy to get inflation under control. You want to destroy private sector money. They are destroying private sector money. And ultimately, they're going to ride to the rescue some quarters from now with the reflation in the public sector money. But that's a process. Right now, we're on this mountain here, and we got to get to this mountain here, and there's a valley. And the valley is lower stock prices, lower digital asset prices, lower prices of houses and everything until the Fed panics and blinks. The Fed is not going to blink with core PCE compounding at almost 2.5 times its price stability mandate, or the unemployment rate at basically a 50-year low. They're going to blink when those numbers are reversed. And that, in my opinion, is a problem because we're at some very lofty valuations across many assets that, are basically implying that they already blinked, and they have not.
Mm. Hate to leave it on that foreboding note, but we need the truth.
Can I leave it on a brighter note?
Gotta hear it. So
I'll leave it on a brighter. I'll leave it on a brighter note than that. This part of the game is a lot less to do, in my opinion, than your ability or my ability or anyone's ability to analyze data and perfectly pinpoint where we are in the business cycle and what the Fed's going to do in response to that. This part of the game, in my opinion, has a lot more to do with you understanding your own strategic investment objectives. Are your investment objectives trying to get rich quick? Because if you're trying to get rich quick, you're probably looking at a chart of Bitcoin and the S&P and you're buying it here. If your investment objectives are to make a lot of money in bull markets, don't lose a lot of money in bear markets, I would argue 99% of investors should be doing, then this is probably not a good time. So I think the number one thing that you should be taking away from anything that I said today is just understand that we're probably not at the beginning of the next bull market. You need to have patience to get to the next bull market without blowing up a significant amount of your capital in what we think is likely to be a phase 2 credit cycle downturn. So, again, just risk manage your own emotions. Don't necessarily, you don't even need to pay too much attention to data. To me, it's about your emotions. And I think everybody can do it. I believe in you.
That is a great note to leave us on, Darius. Keep that powder dry so you have something to work with when we get to that point. Darius, it's always great to see you. Thank you so much for being with us.
Man.
Great stuff. We will be back tomorrow, same time. Peter Bookvar is going to be with us. He's been watching that credit cycle really closely, so I'm sure he'll have a lot to say about that. Please join us then. In the meantime, take care.
Thank you, Maggie. Always a pleasure.
All right, fantastic. Take care, everybody. Good luck out there.